Hello and good evening, everyone. Thank you for sticking it out this far in the CLE. I know everyone's had a long day, but hopefully the topic we're about to discuss will make things a little bit livelier. My name is Cameron Hufar, and I'll be attempting to present to you as much as I can about the tax changes and financial incentives that occurred in 2020 and 2021. I tend to be long-winded, so forgive me if we don't make it all the way through. The first portion of this presentation will be focused on the CARES Act and other stimulus incentives that have occurred. The second portion of this presentation will focus on some notable individual tax changes for 2020. And the last portion of this presentation will review some interesting tax court cases from 2020. Since we're short on time, let's begin. Our first topic of the day is the CARES Act, short for the Coronavirus Aid, Relief, and Economic Security Act. This act isn't solely a tax law or tax change, but it does deal with money and it has tax ramifications, so I felt we should review it. The act was passed by Congress with bipartisan support and then signed into law by President Trump on March 27, 2020. The act was designed to help struggling Americans during the pandemic and to provide relief in the battle against COVID-19. The act authorized more than $2 trillion to provide cash relief for individuals, loans for small businesses, and support for medical providers, among other things. The act was broken into 5 parts. While we're not going to thoroughly review all of the act's parts, we are going to dive into 3 of them and do a quick overview of the last 2 parts. The first part of the CARES Act is Title I, which is also known as the Keeping American Workers Paid and Employed Act. This first title encompasses all of the topics that you see on this slide. Remember that some of these topics have been updated or supplemented. In our short time together, we do not have time to review all of those revisions and updates to each of these topics. However, we will highlight what I've deemed to be important topics and issues in Title I. The Paycheck Protection Program, better known as the PPP, was a loan program for eligible small businesses. The loans were designed to assist small businesses with their payroll obligations and limited operating costs. For purposes of our short time together, we'll discuss the 2 different rounds of PPP loans on the same slide and at the same time. However, the first round of PPP loans was included in the CARES Act on March 27, 2020, and the second round of PPP loans was signed into law on December 27, 2020. The first PPP round was for sole proprietors, independent contractors, the self-employed, nonprofits, and businesses with 500 or less employees. The maximum loan that you could receive was $10 million, and your loan amount was determined by 2.5 times your average monthly payroll. Now, in order to qualify for the loan, you did not need to show any reduction in income or hardship, but you did have to submit documentation evidencing your payroll costs. Any loans obtained could be forgiven through the appropriate application process. At least 60% of the loan proceeds were required to be used for payroll and employee benefit costs. The remaining 40% of the loan proceeds could be used for certain qualified expenses such as rent, mortgage payments, and utilities. The second PPP round, which ended May 31st, 2021, just a few days ago, was for businesses that had previously received a PPP loan during the first round. The size of your second PPP loan was based upon the amount of payroll you used to calculate your first PPP loan. However, additional requirements or limitations were placed on the second PPP loans. First, the restriction on the number of employees was reduced from 500 employees to 300 employees. In addition, the maximum attainable loan was reduced to $2 million. The biggest change from the first round to the second round was the requirement that a business had to prove that at least a 25% reduction in income had occurred between comparable quarters in 2019 and 2020. I know that's a little bit of a mouthful, so let's go through an example. Let's pretend that a business would compare its first quarter in 2019 to its first quarter in 2020 to see if they experienced at least a 25% reduction in income. If there was not at least a 25% reduction for those quarters, then the business would compare the second quarter of 2019 to the second quarter of 2020. While the 25% reduction requirement was a loan limitation, the rules regarding what you could spend the loan proceeds on were relaxed. New eligible expenditures included software, accounting, property damage, supplies, and worker protection equipment. Somewhat similar to the PPP loans were the Emergency Economic Injury Disaster Loans and Grants, also known as the EIDL. The EIDL was broken up into two categories. The first category was an actual loan through the SBA that was required to be repaid. The second category was a grant that was not required to be repaid. Let's look at the differences between these two EIDL programs. The maximum amount that you could receive as an EIDL loan was $2 million. The loan had an interest rate of 3.75% regardless of your credit worthiness. The loan had a payment term of 30 years and had no prepayment penalty or fees. The loan proceeds were to be used towards the business working capital and normal operating expenses. Some of the loans required a personal guarantee of the business owner, and loans over $25,000 required granting a security interest to the SBA in the business's assets, equipment, machinery, and furniture. This program is still available to applicants who wish to obtain this type of loan. The maximum amount that you could receive as an EIDL grant, also known as the EIDL advance, was $10,000. The grant did not require repayment and did not require any personal guarantee. The grant had no interest rate or restriction on how the funds were to be used. In essence, this was free money that the SBA was giving out to business owners. Unfortunately, the deadline to apply for the grant was December 31st, 2020. In more bad news, business owners would have to repay their EIDL grant if they also received a PPP loan. Now, included in Title I of the CARES Act were significant benefits for certain debtors in bankruptcy court. For those of you who are not familiar with bankruptcy, there's 6 chapters of bankruptcy. Those chapters are 7, 9, 11, 12, 13, and 15. Chapter 7 is for individuals. Chapter 9 is for municipalities and school districts. Chapter 11 is for individuals and businesses. Chapter 12 is for professional farmers and fishermen. Chapter 13 is for individuals. And Chapter 15 is for foreign countries. The CARES Act made changes to Chapter 11 and Chapter 13 bankruptcy law, and the changes were very debtor-friendly. The first bankruptcy law change deals with small business reorganizations, or Subchapter V, or 5, in Chapter 11 bankruptcies. In 2019, the Small Business Reorganization Act, or the SBRA, created the Subchapter 5 of Chapter 11 bankruptcies. Subchapter 5 was for small businesses to receive a streamlined bankruptcy process. In order to qualify for the Subchapter 5 bankruptcy, a business debt originally was limited to $2.7 million or less. The CARES Act increased this debt limit to $7.5 million. This change allowed many more businesses to take advantage of the streamlined Chapter 11 process. Unfortunately, the debt limit increase is only temporary and expired on March 27th, 2021. A Chapter 13 bankruptcy, in oversimplified terms, is for individuals who either make too much money to qualify for a Chapter 7 bankruptcy or are trying to save a home from foreclosure. Typically, a Chapter 13 bankruptcy is limited to a term between 36 months and 60 months. That's 3 years to 5 years. Now, Chapter 13 bankruptcies were not allowed to surpass a 60-month time frame before the CARES Act. However, the CARES Act increased the 60-month limit to 84 months, giving Chapter 13 debtors an additional 2 years to pay off their creditors and be under the protection of bankruptcy. Now, at this point, you may be asking why anyone would want to be in bankruptcy longer than they have to. And I can answer that question with a simple pretend scenario. Let's pretend that your house is set to be foreclosed upon next week, and your mortgage company refuses to stop the foreclosure unless you pay all of the mortgage payments that you've missed. Since you were laid off last year because your company went under, you haven't been able to pay your mortgage in 12 months. This means that you're now $20,000 behind in your mortgage. Unfortunately, you don't currently have the $20,000 needed to give to the bank to stop the foreclosure next week. And so in this typical example, you would likely file for Chapter 13 bankruptcy, which would give you up to 60 months or 5 years to pay back the $20,000 that you owed in your mortgage arrear payments. This means that you would need to pay roughly $333 a month in bankruptcy for 60 months to repay the $20,000 that you owe the mortgage company. But under the CARES Act, you would now have 84 months to pay back the $20,000, resulting in a lower payment of $238 a month. Now, one other benefit to Chapter 13 debtors, courtesy of the CARES Act, is that any COVID-19 related stimulus income is not considered income when determining the debtor's income for Chapter 13 purposes. In essence, bankruptcy courts are not going to consider stimulus payments as income. Some other items worth mentioning under the CARES Act are the issues you see on this slide. The Small Business Administration's Office of Entrepreneurial Development provides training and counseling to small businesses. Local entrepreneurial development offices provide local one-on-one training for business owners. The Small Business Administration's Women's Business Centers work closely with women-owned businesses to ensure that they have adequate business resources and access to federal contracts. The CARES Act provides $240 million to the Office of Entrepreneurial Development and the Women's Business Centers. 80% of those funds are to go to the Office of Entrepreneurial Development, and 20% of those funds are to go to the Women's Business Centers. Generally, any federal funds that a business owner receives from these programs, the SBA must match. However, the CARES Act waives the matching requirement for a 3-month period. The State Trade Expansion Program gives grants to states in order to carry out programs to assist small businesses. Some of the issues that are covered include participation in foreign trade missions, trade show exhibitions, and training workshops. The CARES Act allows grant funds that were available in 2018 and 2019 to also be available in 2020. In addition, the grants can be used to reimburse states that had business events canceled due to COVID-19. The CARES Act also provides $10 million to the Minority Business Development Agency to provide counseling, training, and education on federal resources for businesses that participate in the Minority Chambers of Commerce. Finally, Title I of the CARES Act requires the SBA to pay all principal, interest, and fees on all SBA loan products for 6 months for any business that was negatively affected by the COVID-19 pandemic. Any loans that were already on deferment would receive another 6-month deferment. Roughly $17 million was set aside for these SBA loan subsidy payments. Now, we've just covered Title I of the CARES Act, which brings us to Title II. Title II is devoted to the assistance of American workers, families, and businesses. And Title II includes the fantastic benefits that are listed on this slide, which we will go into right now. On March 18th, 2020, President Trump signed into law the Families First Coronavirus Act, also known as the FFCRA. This law provided flexibility for state unemployment agencies to administer additional funding due to the COVID-19 pandemic. On March 27th, 2020, Title II of the CARES Act was signed into law by President Trump. At the time the act was signed into law, 30 million Americans were claiming unemployment benefits. Title II increased eligibility for state unemployment by allowing certain Americans to receive unemployment who would otherwise not have received unemployment had it not been for the act. These certain Americans included people who had already exhausted their state benefits, people unemployed due to COVID-19 health reasons, people seeking part-time work, and self-employed workers. The act also increased the duration that a person could receive unemployment benefits. The act provided for an additional 13 weeks of federally funded benefits on top of whatever the normal benefit duration was for a particular state. At the time, state unemployment durations ranged from 13 weeks to 20 weeks. Now, typically, a person's unemployment benefits are a shared responsibility between the federal government, which pays for half, and the state government, which pays for the other half. The Families First Act, which was enacted just before the CARES Act, increased the federal share from 50% to 100% through the end of 2020. The CARES Act also sought to expand on the benefits provided by the Families First Act and provided unemployed Americans with an additional $600 per week in addition to any other unemployment compensation. Just as a comparison, in 2009, after the recession, the American Recovery and Reinvestment Act provided for a $25 increase in weekly unemployment payments. At the time the CARES Act was signed into law, Massachusetts paid the highest unemployment weekly rate of $557 per week, and some of the lowest weekly unemployment benefits paid were by Louisiana at $211 per week and Puerto Rico at $162 per week. Lastly, the CARES Act addresses the waiting period that some states have. Some states have a waiting period, oftentimes 1 week, before a person is eligible for unemployment benefits. While the CARES Act did not eliminate the waiting periods, instead it reimbursed 100% of the benefits paid during the first week of an individual's unemployment benefits if the state waived its waiting period. This meant that the federal government would cover the cost of any unemployment benefits paid to Americans during the time a state would normally have a waiting period. Probably one of the more popular provisions of the CARES Act, Title II, provided Americans with 2 stimulus payments. However, the stimulus payments were called recovery rebates or economic impact payments. But for the purposes of my speech today, we're just going to call them stimulus payments. Now, these stimulus payments came in at different times. They were different amounts, and they had different rules associated with them. The first stimulus payment amounts were $1,200 for individuals, $2,400 for married couples, and an additional $500 for each qualifying child. The definition of a qualifying child was the same for tax purposes, but was limited to children who were 16 years of age or younger. In order to receive the first stimulus payment, you needed to be a U.S. citizen or resident alien in 2020, not be claimed as a dependent on another person's tax return for 2020, have a valid Social Security number, and meet certain income qualifications. Married couples filing jointly could not have income above $150,000. Head of household individuals could not have income above $112,500, and taxpayers with any other filing status could not have income above $75,000. Controversially, the income amounts were based upon your 2019 or 2018 income tax return. Failure to file a 2018 or 2019 income tax return likely resulted in a stimulus payment not being sent. The second stimulus payments had the same income barriers, but the amount of the stimulus payments differed greatly. For the second stimulus, individuals received $600, married couples received $1,200, and head of households received an additional $600 per qualifying child. The definition of a qualifying child for the second stimulus remained the same as the definition for the first stimulus payment. Now, for the tax year 2020, which some of you may not have filed yet, you're required to report to the IRS whether you received your first or second stimulus payment. If you received the first or second stimulus payment, you must inform the IRS how much you actually received. The IRS will then calculate how much you are entitled to, and if you did not receive your fair share of the stimulus payments, you would be given a refundable credit on your 2020 tax return. This means that anyone who did not receive the actual stimulus payments would get on their 2020 taxes as a refund or tax credit. Anyone who received more than they were entitled to is not required to give back the overpayment. But if you feel really guilty and want to return the overpayment anyways, the IRS has issued guidance on how you can return the overpayment to the federal government. The Employee Retention Credit is a payroll tax credit for businesses in the amount of 50% of wages paid plus health insurance costs. In order to claim the credit, you must be able to show that your business operations were fully or partially suspended due to a COVID-19 related shutdown order, or that your gross receipts declined by more than 50% when compared to the same quarter in 2019. This credit was for any payroll costs incurred between March 13th, 2020 and December 31st, 2020, and was limited up to $10,000 of eligible wages per employee. The bad news was that any business that obtained a PPP loan was no longer qualified for the Employee Retention Credit. In essence, you could not get the benefit of both programs. In more bad news, the rules for the credit are different, depending on how many employees a business had. For businesses with over 100 employees, only wages paid to workers who were not working due to a shutdown would qualify for the tax credit. However, businesses with 100 or less employees would be able to count the wages paid to employees regardless of whether the employee actually worked at the business while the business was shut down or suspended. However, some of these rules were recently changed by the Consolidated Appropriations Act of 2021. First, the requirement that your business must have a 50% reduction in income was decreased to a 20% or more reduction in income. Second, it removed the stipulation that you could not receive a PPP loan and claim the Employee Retention Credit. Now you can do both. Title II of the CARES Act drastically changed how net operating losses are treated. But to understand differences in its treatment, we first need to understand what a net operating loss, or NOL, really is. A net operating loss occurs when a business tax deductions exceed its income in a year. In essence, the business spent more than it made for the year. This often occurs when businesses experience property damage, natural disasters, large business expenses, theft, or moving costs. When this happens, the business has net operating loss, or NOL. Before 2017, NOL could generally be carried back 2 years. This meant that a business that had an NOL could take its unused losses for the current year and apply them to the previous 2 years. This is called a carryback. If there was not any profits to use for the NOL against, then a business could use the NOL in future tax years for the next 20 years. The net operating loss could be used to offset future tax years when the business made a profit. In 2017, the Tax Cuts and Jobs Act was enacted and changed the rules for net operating losses. First, instead of being able to carry back a net operating loss to the previous 2 years, you could no longer carry back any net operating losses at all. However, to make up for the loss in carrybacks, a business could use the net operating loss in the future in perpetuity. The 20-year rule for future tax periods was removed by the Tax Cuts and Jobs Act of 2017. The act also limited the amount of a business's NOLs to 80% of the business's taxable income for that year. Now, the CARES Act changed the net operating losses once more. The CARES Act allows a business to carry back its net operating losses again, but this time it allows a business to go back 5 years instead of 2. The CARES Act kept the ability for a business to use a net operating loss in the future in perpetuity. The CARES Act also removed the 80% taxable income limitation on the amount of a business's net operating losses. Therefore, there was no limit to the amount a business could have as a net operating loss. And lastly, the CARES Act made itself retroactive, starting with the tax year 2018. Thus, the rules for net operating losses under the Tax Cuts and Jobs Act of 2017 only apply to the tax year 2017 and pick up again with the 2021 tax year. Our next Title II topic deals with retirement plan relief and retirement plan distributions. First, Title II allows individuals to withdraw up to $100,000 from their defined contribution retirement plans and treat the withdrawal as a tax-free loan or a taxable withdrawal. If the person chooses to go the loan route, any funds put back into the retirement account will not be taxed to the person. If the person chooses to go the taxable route, the person has the ability to spread the tax liability over a 3-year period instead of having to pay it all in 1 year. In addition, the retirement withdrawal would not be subject to the extra 10% penalty if the person is under age 59 and a half. The retirement withdrawal or distribution also will not be subject to withholdings. Title II of the CARES Act also waives a required minimum distribution for 2020. Now, if you're not familiar with required minimum distributions or RMDs, it's a rule that states that anyone with a retirement plan who's older than age 72, and it used to be age 70 and a half before 2020, or anyone that inherited a retirement plan from a deceased loved one must withdraw a certain amount from their retirement plan every year or face a tax penalty. Think of it as Uncle Sam making you spend your money. Most people do not like RMDs because it means their retirement plan is dwindling due to withdrawals instead of increasing. And RMDs also result in taxable income to individuals regardless of whether they want to receive the additional income. Now, our next Title II topic affects 44.7 million Americans. Student loan debt has become a hot political topic in recent years, mainly because the amount of student loan debt has surpassed every other type of debt that Americans face. But Title II helped alleviate some of those concerns with its two main student loan debt policies. First, the CARES Act stated that an employer could provide up to $5,250 in educational assistance to its employees, and the benefits would not be taxable to the employee. In the days before the CARES Act, employees would be taxed on any educational assistance they received from their employers. Despite being tax-free to the employee, the employer is allowed to deduct the payment of the education assistance. This provision remains in effect until December 31st, 2025. Second, the CARES Act gave everyone with a federal student loan some big relief. The CARES Act states that all federal student loan payments will not be required until September 30th, 2021. This means that a student loan borrower could make payments toward their student loan debt, but it wasn't required. Anyone who set up automatic payments towards their federal student loans were informed that their automatic payments would be suspended. In addition to stopping the payment requirement, the CARES Act stated that no interest would be charged on all federal student loans until September 30th, 2021. Also, all collection towards federal student loans would terminate. In essence, the CARES Act put a freeze on everyone's student loan debt, reducing everyone's interest rate to 0% and removing any requirement to pay on the debt for quite some time. However, and unfortunately, the CARES Act student loan relief does not apply to private student loans. Now, in addition to student loan relief, Title II of the CARES Act provided for foreclosure and eviction relief. Section 4022 of the CARES Act stated that all federally backed residential mortgages must give a borrower a forbearance of their mortgage payments up to 180 days if the borrower is experiencing a hardship as a result of COVID-19. At the end of the 180-day forbearance, the borrower can ask for an additional 180-day forbearance. During the forbearance, no fees, penalties, or interest were to be assessed, and the borrower also has the ability to terminate the forbearance at any time. In addition to the 180-day mortgage forbearance, Section 4022 stated that federally backed mortgages could not be foreclosed upon for 60 days after March 18, 2020. Section 4023 of the CARES Act dealt with multifamily residential properties with federally backed mortgages. Borrowers of these types of properties could obtain up to 90 days of mortgage forbearance as long as they're able to document their COVID-19 hardship. However, from March 18, 2020 to December 31, 2020, the borrower could not evict anyone for non-payment of rent and could also not charge late fees or penalties. Section 4024 of the CARES Act stated that all eviction proceedings for properties that fall within federally covered housing programs or that have federally backed mortgages cannot be initiated for 120 days from March 27, 2020. In addition, landlords could not charge their tenants any fees or penalties as a result of late rent payments. Also, no notices to vacate could be issued during the 120-day period. And the 120-day period was recently extended by the CDC to cover between March 27, 2020 and June 30th, 2021. Now that we've hit the main highlights of Title II of the CARES Act, let's hit a few more topics worth mentioning before we transition to Title III of the CARES Act. Title II of the CARES Act allows businesses to defer the payment of the employer portion of payroll taxes between March 27, 2020 and December 31st, 2020. An employer's portion of payroll taxes is 6.2% of wages paid, which consists of the employer's portion of Social Security taxes. If an employer elects to use the deferment, the amount deferred must be paid over a period of 2 years. The first half of the deferred portion must be paid by December 31st, 2021, and the second half must be paid by December 31st, 2022. In regards to the Alternative Minimum Tax, or AMT, the Tax Cuts and Jobs Act of 2017 stopped corporations from being allowed to offset their regular tax liabilities with AMT credits. Any excess AMT credits would be refundable to the corporation incrementally between the years 2018 and 2020. However, the CARES Act accelerated the refund schedule, allowing a corporation to claim the AMT credit in either 2018 or 2019. In regards to charitable contributions, the CARES Act allows a taxpayer to deduct up to 100% of their adjusted gross income for cash gifts made to nonprofit organizations. In addition, corporations can now deduct up to 25% of the taxable income for cash gifts made to nonprofit organizations. The downside for individuals, though, is that in order to get the 100% benefit, you had to itemize your deductions on your return. But there's a bit of good news. Even if you didn't itemize your deductions on your 2020 return, you're still allowed a $300 per person charitable deduction, no evidence or documentation required, for cash payments made to nonprofit organizations for the 2020 tax year. Now, switching to a quick mention of business losses, the Tax Cuts and Jobs Act of 2017 limited non-corporate taxpayers to a maximum deduction of $250,000 in excess business losses, or $500,000 for married joint returns. Title II of the CARES Act suspended this rule, effectively allowing an unlimited business loss to be taken for tax years 2018, 2019, and 2020. Now, speaking of businesses, let's go over the new rule for the business interest deduction. Before the CARES Act, a business was only allowed to deduct their interest in an amount not to exceed 30% of the business's income. The CARES Act has changed the income percentage limitation from 30% to 50%. However, this change is only allowed for tax years 2019 and 2020. Now, the rule for depreciating non-residential property improvements was changed drastically by the Title II of the CARES Act. Before the CARES Act, qualified improvements made to non-residential property had to be depreciated over 39 and a half years. The CARES Act reduced the 39.5-year limitation to just 15 years. This allows for taxpayers to recoup their property investments faster than they ever could before. Now, the last topic I wanted to discuss under Title II of the CARES Act deals with hand sanitizer. By now, I'm guessing that hand sanitizer has become a regular business expense for businesses and a regular household grocery item. I'm sure we all remember the times when hand sanitizer, among other items, were hard to find and essentially scarce on grocery store shelves. Well, due to this scarcity, alcohol beverage manufacturers shifted their production from alcoholic beverages to usable hand sanitizer. Alcoholic beverages are generally subject to an excise tax from the federal government, but the CARES Act removed this excise tax placed on distilleries so that they could produce hand sanitizer more efficiently and more cost-friendly for consumers. Now, in the famous words of Kermit the Frog, we're moving right along. Our next topic is simply the next chapter of the CARES Act. Title III of the CARES Act, subtitled Supporting America's Healthcare System in the Fight Against the Coronavirus, focuses on America's healthcare system and the shortages of available drugs and equipment. Title III also focuses on flexibility for healthcare providers and expanding access to COVID-19 testing. While we're going to look at a few of these topics more closely, some of the other topics we won't, and therefore this is a good time as any to briefly review them. First, telehealth services provided by a medical provider are now covered due to Title III. Title III also provides for a $29 million grant program in order to promote telehealth technology and delivery. Title III also states that telehealth satisfies the face-to-face hospice recertification requirement and can be used by nephrologists to evaluate a patient on home dialysis. Second, Title III made targeted increases to Medicare payments and eased some Medicare requirements. Title III provided for a 20% increase to Medicare for patient payment symptoms during the pandemic and temporarily prevents scheduled cuts to Medicare for clinical laboratory rates. Third, Title III placed a temporary hold on the 2% Medicare sequestration reduction through the tax year 2029 in order to put an essential Band-Aid on Medicare's poor long-term financial outlook. Fourth, Title III reduced the waiting time for rehired employees and their FFCRA sick leave and FMLA leave, making employees immediately eligible for these benefits if they were laid off after March 20th, 2020. Fifth, Title III allows employers to take an advance on their tax credit for paid sick and family leave, which we'll discuss later in a few minutes. Now, speaking of testing, our first topic discussing Title III of the CARES Act deals with COVID-19 testing. Title III required that all public and private health plans, including self-insured groups, were to completely cover the cost of diagnostic testing for COVID-19. The health plan participant or the individual seeking the testing was not to incur deductible or other cost-sharing fees. This essentially meant that COVID-19 testing was free to individuals as long as they had a commercial health insurance plan. Interestingly enough, Title III required that a COVID-19 vaccine, which was not in existence at the time of Title III, was to be fully covered by the health plan with no out-of-pocket expenses to be passed on to the individual receiving the vaccine. The price that was to be paid for COVID-19 testing was to be set and determined by the health insurance companies and the testing providers. This led to a wide range of fees for COVID-19 testing, from the lowest price being around $20 per test to the highest being around $1,500 per test. Now, what's interesting about Title III of the CARES Act is that it did not set a limit as to the number of tests a single individual could receive in a year, and it also did not set a maximum price, or really any price at all, for the cost of the COVID-19 testing that would be charged to the health insurance companies. Now, there's a few educational provisions outlined in Title III of the CARES Act, and one of those provisions deals with the waiver of matching funds for schools receiving federal grant money. Before the CARES Act, any school that received federal funding for schools to give out grants based upon financial need or work-study programs, the school had to match the amount of grant money they received from the federal government. Title III waived that requirement, allowing schools to receive federal funds to be used for educational grants without the school having to kick in some of their own funds. Title III also allowed schools to use federal grant money to assist students who were determined to be in a financial aid emergency due to unexpected expenses and unmet financial obligations. Title III also allowed work-study students who were paid for their work under the work-study programs to still receive payments as if they were working at the school, even if they weren't actually allowed to work due to COVID-19. This provided a method for schools to still be able to pay their work-study students without actually having them to work in the work-study programs because of the non-operation due to the pandemic. To further assist students, Title III allowed students to receive federal assistance for education provided by distance learning, such as through the internet. Before Title III, students must attend school in person in order to receive the federal funding. Due to Title III, students could receive federal funding for online education. However, this provision only applied for the tax years 2019 and 2020. Now, somewhat similar to Title II, and the suspension of student loan payments, Title III of the CARES Act provides that any month in which a student loan payment that is deferred due to the pandemic will be treated as being paid by the student for purposes of determining the student loan forgiveness calculations under federal programs and for credit reporting purposes. Title III also provides provisions to allow students to apply to have their student loans canceled if the student had to withdraw from school before the end of the school year due to a qualified emergency. Title III of the CARES Act made substantial changes to the Family Medical Leave Act, or FMLA, and Emergency Paid Sick Leave Act. Under the changes for sick leave, the CARES Act stated that an employer's liability is limited to $511 per day, up to a maximum of $5,110 per employee for any employee that is unable to work because the employee was sick due to COVID-19, ordered to self-quarantine or isolate, or experience COVID-19 symptoms. Any amounts paid by an employer under these provisions of sick leave will be given a payroll credit. Now, under the changes for FMLA and sick leave, an employer's liability is limited to $200 per day, up to a maximum of $12,000 per employee, for any employee that is unable to work because they're caring for a family member who has COVID-19, their daycare has closed or is unavailable due to COVID-19, or experienced COVID-19 symptoms. This was a hotly debated topic and often misinterpreted topic last year when I first started talking about these regulations. And fortunately for you all, I made a slide last year that helps explain the differences between the two regulations and hopefully provides a little more understanding for business owners. As you can see in the graphic displayed, there were various guidelines put forth as part of the Families First Coronavirus Response Act. For both caring for sick family members and school or daycare closures, the first 2 weeks of pay is 2/3 the pay of the normal salary for the employee taking the time off. The following 2 weeks for each category are unpaid, with the difference in pay only for school or daycare closures to follow. Quarantine or COVID pay is full pay for the first 2 weeks and then unpaid time off after that 2-week period. These guidelines apply to companies between 50 and 499 employees. While this is not a benefit necessarily to businesses, it does ensure that employees who are dealing with COVID are still receiving pay at adequate rates. In addition, the IRS recently announced that this pay would be eligible for the refundable tax credits. This is to say that the paid time for employees will be reimbursed as a tax credit to the business, with excess pay coming back to the business as a refund. In some good news for businesses with retirement plans, Title III provides businesses with a few bits of assistance regarding their responsibilities with their retirement plans. First, an ERISA plan sponsor can elect to treat the plan's adjusted funding target attainment percentage, also known as the AFTAP, for the last plan year ending before January 1st, 2020, as the AFTAP for plan years including 2020. Second, employers were given a delayed deadline to pay their minimum funding contributions under ERISA. Any minimum plan contributions that were due during the calendar year 2020 were moved to be due January 1, 2021. However, if the employer elects to accept this delayed payment deadline, the employer will have to pay any interest that accrues between the original due date and the expanded due date. Third, employers were given a 1-year ERISA filing deadline extension if they can show that their business was affected by a public health emergency such as COVID-19. Now, by now, I'm sure all of you are tired of hearing about the CARES Act. Well, too bad. We still need to discuss Titles 4 and 5 of the CARES Act, but as a good gesture to you, we'll very briefly discuss Titles 4 and 5. Now, Title IV provided for $25 billion in funds to support the airline industry and to prevent the closure of various passenger airline companies. A portion of this funding is used to pay employee wages, salaries, and benefits. Another $25 billion was made available as loans for cargo air carriers, and another $17 billion was set aside as loans for businesses critical to maintaining national security. Now, Title IV also provided for $454 billion in loans, loan guarantees, and investments in facilities established by the Federal Reserve. Title IV also suspended the requirement of financial institutions to use generally accepted accounting principles when dealing with loan modifications related to the pandemic. And Title V of the CARES Act provides for $150 billion in funds for states, territories, Indian tribes, and local governments to effectively respond to the pandemic. Now, at this point, we've been through a lot together. We've spent our entire time together thus far discussing the CARES Act. I realize that most of you probably need a break. And despite what most of you think, I'm not a heartless man. I'm fully aware of the needs of my audience. And therefore, I'm willing to give you a quick break before we begin our next topic. Your break starts now. Okay, that's enough. Our next topic is the American Rescue Plan, signed into law on March 11th, 2021. According to President Biden, at the time of the American Rescue Plan was signed into law, over 20 million Americans had contracted COVID-19 and over 370,000 people had died from the virus. In an attempt to aggressively fight the detrimental effects of the pandemic, the government passed the American Rescue Plan of 2021. The 9 topics on this slide are the main topics of the American Rescue Plan of 2021 that we're going to be covering during this presentation. The economic impact payments, also known as the third stimulus, was the third round of payments that the federal government issued to individuals in order to combat the effects of the pandemic. Eligible persons were to automatically receive $1,400 for individuals, $2,800 for married couples, and an additional $1,400 for each dependent. In short, the payments were $1,400 per person. Now, unlike the other stimulus payments requiring that dependents be under the age of 17, the third round of stimulus payments for dependents were entirely based upon the amount of dependents claimed on a person's tax return. However, the income phase-out thresholds were the same as they were for the other 2 stimulus payments, with limits of $75,000 for single filers, $150,000 for married couples filing joint returns, and $112,500 for head of household filers. Depending on your filing status, if you made over these amounts, then you would not receive an economic impact payment or third stimulus. In more bad news, the government is continuously working to get the stimulus payments to individuals that didn't have bank accounts or that have moved, such as the homeless, rural poor households, and other financially distressed Americans. Without a consistent mailing address or a bank account that accepts direct deposits, the federal government is unable to pay the stimulus to individuals in an easy and expedited manner. For the taxpayers without children, the American Rescue Plan increased the maximum amount of earned income tax credit from $543 to $1,502, almost tripling it. For taxpayers with children, the American Rescue Plan increased the child tax credit from $2,000 to $3,600 for children under the age of six, and from $2,000 to $3,000 for children between the ages of 6 and 18. The ARP also made the child tax credit fully refundable, thereby increasing the amount an American family may receive back in the form of a tax refund. And for the first time, the child tax credit is now available for Americans living in Puerto Rico or U.S. territory. Also, for the first time, taxpayers are allowed to obtain their child tax credit amount early through 2021 by receiving an advance on their credit. Now, for the taxpayers who elect to receive the advance, the IRS will send periodic monthly payments to the taxpayer starting from July 1, 2021 to December 31, 2021 to allow families earlier access to these much-needed funds. The ARP also increased eligibility for a child independent care tax credit and increased the total credit to $4,000 for one qualifying individual and $8,000 for two or more qualifying individuals. Now, to help facilitate the advance payments of the child tax credit, the IRS will be creating an online portal for taxpayers to access and utilize. The portal will allow taxpayers to claim the advance, even if they didn't file a previous tax return. The portal will also allow taxpayers to decline the advance payments and be able to receive the full amount of the credit on their 2021 tax return. The American Rescue Plan provides for $350 billion in emergency funds for state, local, and tribal governments to enable them to continue to support the public health response and lay the foundation for a good economic recovery. Of the $350 billion in aid, $195 billion is designated for states with a minimum of $500 million going to each state. $130 billion is designated for local governments, $20 billion is designated for tribal governments, and $4.5 billion is designated for U.S. territories. In addition to the $350 billion, another $10 billion was set aside for states, territories, and tribes to cover the cost of broadband infrastructure. This particular $10 billion is to be used to improve internet throughout the country so that all communities can have access to high-quality internet. Now, the Treasury Department is to provide financial assistance as required by the ARP of roughly $10 billion to states, territories, and tribes in order to assist homeowners with their mortgage payments. Each state is to receive a minimum of $50 million, but each state must apply for these funds. Now, the funds are only to be used for socially disadvantaged households and households with income of 150% or less of the median income, including people who have been subjected to racial or ethnic prejudice or cultural bias due to their identity as a member of a group. The following groups have automatically been deemed to be socially disadvantaged: African Americans, Hispanic Americans, Native Americans, Asian Americans, and Pacific Islanders. Any assistance a homeowner receives must be used for qualified expenses, such as mortgage payments, mortgage arrears, utilities, internet service, insurance, HOA fees, delinquent taxes, home repairs, and down payment assistance. There's also a special rule that at least 60% of the $10 billion available in assistance must be used for Americans with 100% or less of the median area income. Now, it's up to each state as to how they want to implement a plan for applying for the funds, dispersing the funds, and using the funds. Not to be left out, renters also can receive benefits under the American Rescue Plan. The ARP provides for $21.6 billion available for states, territories, and local governments to disperse to their constituents in order to assist with rental payments. Each state is set to receive a minimum of $154 million. And $305 million has been set aside for Puerto Rico and U.S. territories. Individuals will need to apply with their local government or states in order to receive the rental assistance, and any assistance received must be used to pay rent or utilities. Now, in order to combat the hardships that small businesses have endured during the pandemic, the ARP has allocated $10 billion to assist those small businesses. Of the $10 billion allotted, $1.5 billion is to be used solely for socially and economically disadvantaged people, such as businesses owned by women and minorities. Another $500 million was allocated for very small businesses that have less than 10 employees. Once again, states that are left to devise how they want business owners to apply and how they want the funds to be dispersed. Now, in addition to the State Small Business Credit Initiative, the American Rescue Plan expands the Employee Retention Credit and the paid leave credit available for employers. The Employee Retention Credit is now available through December 21 and allows businesses to offset their current payroll tax obligations by up to $7,000 per employee per quarter. This amounts to a credit of up to $28,000 per employee for 2021. This credit is available to businesses who have seen their revenues decline or have been shut down due to COVID-19. Now, the paid leave credit is now available through September of 2021 and allows businesses a dollar-for-dollar deduction of up to $5,000 in wages paid to employees who are unable to work because they're sick or under quarantine. This includes time taken off work to receive COVID-19 vaccinations. In order to be eligible for the paid leave credit, an employer must have less than 500 employees. However, the employee who is sick or under quarantine cannot be able to work, including working from home, such as telework. Now, before the American Rescue Plan, any amount that a taxpayer received in unemployment benefits were treated as taxable income and needed to be reported on the taxpayer's tax return. However, the American Rescue Plan now allows the taxpayer to receive up to $10,200 in tax-free unemployment benefits. The one caveat is that the taxpayer must be of a middle or lower income class. While the provision of the American Rescue Plan is only for the 2020 tax year, the IRS is going to be auto-calculating and issuing tax refunds to any taxpayers who already paid a tax on the first $10,200 in unemployment benefits because they've already filed their return. Taxpayers who received their original refund by direct deposit will receive their supplemental refund also by direct deposit. All other taxpayers will receive their supplemental refund by checks sent through the mail. So far, we've reviewed the 5 titles of the CARES Act, and we've gone through the 9 important topics of the American Rescue Plan. Now, I want to quickly review some of the tax updates that are applicable to individuals for 2020. While these aren't all of the tax updates that occurred for individuals for 2020, we'll cover a select few of the important updates that I've deemed to be most important. On the slide before you is a sample tax bracket for the 2020 tax year. While each filing status has the same tax rates, the lowest being 0% and the highest being 37%, each filing status has a different income threshold in order to get to a specific tax rate. Now, for comparison, in 1980, the lowest tax rate was 0%, just as it is now, but the highest tax rate was 70%. If you were a single tax filer in 1980, any income over $108,000 would be taxed at 70%. Married couples filing jointly in 1980 were taxed at the 7% tax rate for all income over $215,000. Now, one notable update to the retirement plans for 2020 is that the Secure Act has changed the age when required minimum distributions must be made. The old rule was that anyone aged 70 and a half or older must begin taking required minimum distributions from their retirement plans. However, this age has now been increased to anyone aged 72 or older. In addition, no one was required to take a required minimum distribution for 2020 regardless of their age. Another notable update is that people can withdraw up to $5,000 from their retirement plan without incurring the additional 10% penalty for being under age 59 and a half, as long as the funds are used to have a baby or adopt a baby. However, under the Secure Act, all inherited IRAs and workplace retirement accounts must be emptied out within 10 years of the date of the owner's death. The exceptions are for surviving spouses, minor children, or disabled or chronically ill children. It's important to note that these distributions must be taken each year during the 10 years, with the 10th year being the year in which the account is emptied out. But in more good retirement plan news, I want to remind everyone that Title II allows individuals to withdraw up to $100,000 from their retirement plans and treat the withdrawal as a tax-free loan or a taxable withdrawal. If the person chooses to go the loan route, any funds put back into the retirement account will not be taxed. If the person chooses to go the taxable route, the person has the ability to spread the tax liability over a 3-year period instead of having to pay it all in 1 year. In addition, the retirement withdrawal will not be subject to the extra 10% penalty if the person is under age 59 and a half, and the retirement withdrawal or distribution also will not be subject to withholdings. Now, in scary news, but also some good news, there are 4 tax benefits that previously died but have come back to life for 2020. Our first zombie is the tuition and fees deduction, which allows a taxpayer to deduct up to $4,000 in qualifying tuition and fees paid to go to college. There are income phase-outs that are used to reduce the $4,000 incrementally. Our second zombie is the mortgage insurance premium deduction, which allows a taxpayer to deduct any private mortgage insurance premiums paid to their mortgage company. This deduction is only allowed for taxpayers who itemize their deductions. And if you're not familiar with mortgage insurance premiums, also known as PMI, it's an extra fee a mortgage company charges a borrower for not putting at least 20% down on the purchase of a property. Our third zombie is debt forgiveness on foreclosures, which allows a taxpayer to treat up to $2 million in discharged debt related to a foreclosure or short sale as a tax-free benefit. Without this zombie, any discharged debt from a foreclosure or short sale would be treated as taxable income. Our last zombie for this slide is the energy efficient home improvements deduction, which allows taxpayers to receive a credit up to 10% of the cost of qualifying windows, doors, skylights, roofs, and insulation. These improvements must be made on the taxpayer's primary residence, and there's a lifetime maximum of $500 that can be claimed for improvements made since 2006. There's also a lifetime maximum of $200 for new windows, $50 maximum for circulating fans, and $150 maximum for furnaces or hot water boilers. Now, the earned income tax credit is available to low-income earning taxpayers who have earned income, meaning they worked for someone and earned an income, as opposed to unearned income, such as investments. For those taxpayers who were unemployed for all of 2020, they are still eligible for the earned income tax credit. Anyone who lost their job or had a change in income for 2020 can elect to use their 2019 income to qualify for the earned income tax credit for 2020. This rule, allowing taxpayers to use their 2019 income for determining qualification for 2020 credits, also applies to the additional child tax credit. Now, the additional child tax credit is for taxpayers who did not get the full amount of the child tax credit. A notable change in payroll taxes was the amount of income subject to payroll taxes that were increased from $132,900 in 2019 to $137,700 for 2020. The good news is that the payroll tax rates remained unchanged, with Social Security at 6.9%, Medicare at 1.45%, and the Medicare surtax at 0.9% tax rate. Now, in August of 2020, President Trump issued an executive order allowing employers to suspend the collection of payroll taxes from September 1st, 2020 until December 31st, 2020 for workers who make less than $4,000 for any biweekly pay period. For those not so good at math, this basically equates to $2,000 a week. While the tax wasn't eliminated, employers had the option to delay the payment of the payroll taxes until 2021. The suspended payroll taxes would be deducted from the employee's wages from January 1, 2021 to December 31st, 2021. The IRS also issued a new Form W-4 to get rid of claiming personal exemptions. Instead, employees are to choose their filing status and number of dependents in order to determine the correct withholding amount. The new W-4 form applies to all new hires and to anyone who wishes to adjust their payroll withholdings. Now that we've reviewed the CARES Act, the American Rescue Plan, and some individual tax updates, let's get into my favorite part of my speeches, the wild and crazy court cases. Our first United States tax court case comes from a form of a 2006 decision. In this case, Mr. Mark George was a member of an Indian tribe, and he believed that the federal government had no ability to place a tax on Native Americans. Mr. George filed a tax return showing no taxes owed because he was exempt from taxation as a Native American. Obviously, the IRS disagreed with his assertion, deemed his tax return frivolous, and assessed all sorts of penalties against Mr. George. One of the penalties that the IRS assessed was the penalty for failure to file a tax return. In a decision that might surprise you, the U.S. tax court sided partially with the IRS and sided partially with Mr. George. The tax court stated that Native Americans, like all other Americans, are subject to tax and do not enjoy a special exemption from federal taxation. However, the tax court stated that Mr. George actually did file a return despite claiming zero in tax liabilities, and therefore the IRS could not assess a failure to file a tax return penalty against Mr. George. The lesson here is that no one escapes the long arm of the IRS. A recurring theme in the litigation world, especially in the tax litigation world, is that attorneys make up some of the biggest complainers. And in this case, Lon Isaacson, a decision from January 23, 2020, deals with a California former litigator who was disbarred for various financial dealings in 2014. Mr. Isaacson was disputing the IRS's assessment of $2.6 million in taxes and a civil fraud penalty of $2 million. Mr. Isaacson's case involved the IRS allegation that he failed to report his share of a $12.5 million settlement he obtained for his 4 clients against the Catholic Church. Mr. Isaacson's fee arrangement with his clients was for 60% of any settlement proceeds plus 110% of any litigation costs. That's right, you heard that right. Mr. Isaacson added a 10% markup on all litigation costs for his clients. Mr. Isaacson told his 4 clients that he earned his fees in 2007, and therefore he was entitled to his share of the settlement proceeds in 2007. However, he told the IRS that his fee was in dispute, and therefore he did not need to report his share as taxable income until his fees were actually undisputed. The tax court sided with the IRS, using the doctrine of equitable estoppel, stating that Mr. Isaacson could not tell his clients he was entitled to his fee in 2007 and then tell the IRS that he had not yet earned his fees. The lesson here is be consistent with your arguments and don't mark up your litigation costs. In the Hakeem Abubark and Sharmila Kasim case, a decision rendered on January 30th, 2020, the taxpayers claimed $18,000 in income as a travel agent and $94,000 in deductions. The couple was audited by the IRS, and the IRS ended up allowing $47,000 in expenses despite his income being only $18,000. The taxpayers challenged the audit findings and appealed to the tax court. At trial, the taxpayers dumped over 226 documents on the judge, including bank records, receipts, spreadsheets, and other items. After sifting through all of the records, the tax court found that the taxpayers had only proved $37,000 in expenses, $10,000 less than what they had received in the audit. The lesson here is to be mindful of your situation and the overall big picture, despite your emotions and willingness to fight. All right, in a tax court case involving a used car salesman rendered on May 26, 2020, Enrique Aguilar earned a salary of over $140,000 in 2015, working as a car sales manager and a buyer for a dealership. Mr. Aguilar incurred $40,000 in travel expenses, but his employer reimbursed him for those expenses. Reimbursed employee expenses are taxable as income, and the expenses themselves are deducted on Schedule A as an itemized deduction. Mr. Aguilar did not want his travel expenses deducted on Schedule A because it was not a dollar-for-dollar deduction. So instead, he created a Schedule C and deducted every dollar of his travel expenses. Now, the IRS disallowed his travel expenses on Schedule C and stated that he should have been reported on Schedule A. While the tax court sided with the IRS in regards to the location of where the travel expenses could be deducted, the tax court allowed his Schedule C to remain intact because Mr. Aguilar had also claimed $12,000 in various other expenses related to his job on Schedule C that were upheld by the tax court. The lesson here is don't try to create new laws or tax schemes, just follow the rules. The case of James Lloyd, decision rendered on June 22, 2020, involved Mr. Lloyd's ownership of the Christian Media Network. The network had between $260,000 and $400,000 in gross receipts every year, but Mr. Lloyd failed to file tax returns for the last 6 years. The IRS assessed Mr. Lloyd with a total tax liability of $515,000, including $114,000 in penalties, and none of those numbers included the interest. Mr. Lloyd appealed to the tax court, claiming that he owed no taxes whatsoever because Congress only had the power to tax income, and since the word income had no definition in the U.S. Constitution, he could not be taxed. Needless to say, the tax court sided with the IRS and it assessed an additional $2,500 penalty sua sponte. The lesson here is don't tell the IRS that you're immune because they're going to find a way to infect you. Our final case is not really a tax court case at all, but more of a fun thought to leave you with. President Trump, during his days filming The Apprentice, deducted over $70,000 in haircuts on one of his tax returns. This small deduction is worth noting for a few reasons. 1. Personal grooming habits are not a business expense and cannot be claimed as a business deduction. 2. Personal expenses are not allowed as a business deduction. And 3. How in the world does anyone ever spend $70,000 in haircuts in 1 year? The lesson here is live frugally, because if you don't know how, the IRS may teach you how. This concludes our tax presentation for the evening. I want to thank everyone who pretended to listen to me during my presentation and for all the people at home that gave me a standing ovation. My name is Cameron Hufar, and my contact information is listed on this slide if you want to send me any fan mail. But before I go, I shall leave you with a quote from one of my favorite movies that's pertinent to this topic. If the good Lord had intended us to walk, he would not have invented roller skates. In sincerity, thank you everyone for allowing me to be your tax update presenter. It's been a big honor. I hope everyone has a good rest of their evening and their day and a fantastic remaining 2021.